What's up, 50 folders? Now, if you want to engage, attract, retain your staff, you're going to need to give them a share of your company. Now, in this video, I'm going to introduce you to the key concepts that you need to know in order to actually set one up. Then we're going to go through the 50 Folds ESOP model at a high level so you understand how it works. Okay, let's bust this out.
Ask Alex. Ask Alex. Because you don't know what you don't know. And if you don't know, now you know.
Yeah.
Okay, congrats. So you just found a great CTO and now you're thinking, how am I actually going to keep him, right? Well, let's face it, the office, your culture, the stuff HR people do in general, they're pretty important. But really, when you think about it, it's all about the challenging work environment, having an engaging culture, and compelling equity incentives that people feel that they're an owner, that they're a share of your company, okay? But the reality is that people want to get rich too. They want to get rewarded for their hard work. And so money matters. Now, talent want more than just a salary. I mean, they can go to Google and places like that to get that, right? They pay pretty darn well. Kids coming out of college can be getting paid $150K a year. And it's really just that crazy. But people want equity, as that's the way, if the company is successful, that they're going to get rich too, right? Think the first 1,000 people at Facebook. Yay, millionaires everywhere. Now, to understand this, there is no such thing as founder shares, but you, the founders, the first early employees, are going to get shares in the company, all right? They're not options. What you're going to give to everyone else are these things called options, which is a right to get shares in the future, so long as certain things are achieved. Now, the reasons for that are pretty technical. And when it comes down to this, if you're not really sure if you're a later stage company, you are going to need to talk to a lawyer because there can be tax consequences for your staff. And, you don't want them being upset around that, okay? Now, if you want to offer lots of shares to people, right, what you're actually giving is the options. Now, these things are put in a structure called an ESOP, which is an employee share ownership program, okay? That's sort of short code for how they're going to get rich. Now, that pool of ESOP is going to be allocated to people as how you define. And if people leave and they don't take those options, then they get wiped off and there's more left for everyone else. Now, we're going to go through how to structure this and how to actually model it. Now, I'm not a lawyer. You will need a lawyer. There are things that you need to do to change your legal documents in order to be able to offer an ESOP. If you're smart and you're setting up a company now, tell your lawyer that you need to have an ESOP, and you might even be able to set it up for free. Now, it generally shouldn't cost that much, at least for earlier stage companies. Later stage companies may have a higher bill, but that's something you're gonna have to talk with the lawyer. But you will need a lawyer. You can't search in Google and just find some template and think, hey, cool, I'll just hustle and use this. You can't, okay? You actually need to do legal stuff. Now, that legal stuff is put in an ESOP document, which is a really fancy word I just made up just here, okay? That's basically, your ESOP has basically been setting out how the shares are going to be granted to staff in the form of those options. Now, options can take a number of different forms, such as RSUs, ISOs, NSOs, and there are technical reasons of why you will use one versus another. So restricted stock units can make things a little bit simpler sometimes. At least in America, you might not need to do a 409A valuation in order to continually set your share price. Now, when deciding what kind you want to use, you need, again, to talk to your lawyer. There can be times when it makes sense to use an ISO instead of a NSO. So this legal stuff has to be written down in a document, right? It needs to set out all the key terms, and it needs to set out how much equity are you effectively allocating to this ESOP pool, because that ESOP is going to dilute you, right? Now, all the terms are going to be in there. The key terms are going to be things like vesting, the conversion mechanics, And by the way, they apply to everyone unless you effectively issue them a side letter, which is pretty rare, but you will sometimes maybe do for really senior staff. Now, the size of the pool is basically what percentage of your equity are you going to allocate to them. It could be 5%, it could be 10%, it could be even less. Bear in mind that you're creating a pool, right? And these are options, so they're not guaranteed to be given to people yet. So you don't think of creating this pool and all bath water from Gamer Girl needs to be given to everyone immediately. It's something that you create and you can dip into and out over time. So how do you go about setting up this whole ESOP thing? Well, you guys, you hustle, you set up a company, doing whatever, and it's kind of getting some pretty decent traction. Now, you manage to convince one of your friends, John, that he's going to join, and he'll swear that, he'll get shares or something in the future. Only you don't really have cash to donate to the lawyers. Now, you're growing well, and VCs are kind of swarming around, and they want to invest. Only they know that John hasn't really been given any equity or any options yet. And so they're going to insist that that stuff is tied down, that John's going to be happy, and also that you're going to have more to issue to other people. All right? They're going to ask for, say, 25%, which is outrageous. You're then going to say, well, actually, we don't need 25% because we're not going to hire that many people right now. And so we're going to agree on, say, 15%. Why? Because you created this thing called a hiring plan, which sets out who you're going to hire for the, say, 18 months of funding that you're going to be, taking that money for, right? And then if you need people in future over that 18-month period, then you can increase the pool, right? What investors are doing, will tell you it's because, staff, but what they're effectively doing is actually decreasing your pre-money valuation. And that's a sneaky little trick called the option pool shuffle, where they're basically shuffling your shares around in a way that you don't really understand, but what it's actually doing is decreasing your valuation. So be aware of that and just don't accept any number that the VC asks you for, okay? You need to set out who you need and when you need them, and that's called your hiring plan. Okay, then you go to a lawyer gets finally paid, and you have your ESOP now. So you make good on your word to John. John gets his initial grant, and the ESOP will govern it. And hopefully John is happily, and so he doesn't hear that someone more junior than him actually ends up getting, more than him, which basically is not fair. And frankly, fairness is what really drives people, right? And it will really get under the skin if they perceive that your structure's not fair. So it's really important to understand that it's not enough just to give people ownership in your company through options or shares. They need to actually understand that they're worth something, right? Because you're giving it to them to make them feel like an owner, to make them feel that they're going to get rich if they're going to work their ass off every night on the weekend, sacrifice, going to their friend's wedding, whatever it is. But they need to understand the value of that. And you'll often find in underdeveloped ecosystems that they don't really understand the value of those because they don't have any friends who've gotten rich. Now, these things are changing progressively, but it's going to be an educational process for you to educate your staff that these are actually really valuable and they're not just sort of pieces of paper. So once you give them to them, educate the value of them, and then keep educating on the value of them in order to motivate them, right? Make them understand that this is how they're going to get rich if they work hard and you sell the company like you promised them. So how do staff actually start up, cash in, sell out, and grow down? Okay, well, investors will make you set up an ESOP if they're going to fund you. Whether or not you want it, it will be a condition of getting funded. So a percentage of your shares will be allocated, and 100% with certainty will dilute you and anyone who was on the cap table before. It's only when new people come in that something happens that they don't get diluted. Everyone else who was on the cap table before will get diluted by creating an ESOP. So you're going to issue shares to people and use the founder and the board of directors one of the investors will probably have a board seat on your company now, will formally agree to create this ESOP program in order to dole them out to your staff. Once it's been agreed to do that, you are then going to, at every board meeting, agree to give shares or options to those employees. Now, you actually really have to agree them. You can't say to John, hey, buddy, sure, I'll give you $50,000 worth of stock in options. Trust me, it'll be fine. Those are called promised options, which can be dealt with pretty punitively, actually, if you get acquired before you actually make good with John. At every board meeting, if you need to issue your John and Mary and Sarah's, their new equity, that actually needs to be approved by your board of directors first, okay? Otherwise, it doesn't actually count. So there may actually be discussions about how much you're going to give, say, a new lead engineer. But for, if you decide that you're going to give 20% of salary to everyone, including your secretary, they basically just get rubber stamped because that's the structure of your ESOP. Just why bother spending time talking about it? The VCs would rather be back at the office or, with the wife or something like that, right? Now, once John has got his shares, or his options, sorry, he doesn't get them all immediately, okay? You don't want to give John like 4 years worth of options and then him to leave tomorrow and have all that in his pocket, right? That wouldn't make sense. So what you do is you set up a vesting schedule or program with John so that he only gets a share over time, and that's called vesting. So you'll agree on a period of time at which John needs to vest, which is typically 4 years. And John will then need to serve his time in order to 100% vest all of those options. Now understand, options actually have a value. If you are issuing them very early before you've done any funding rounds, etc., that number can actually be really, really small. But the moment you start raising money, etc., those numbers start coming up. Now, the price at which they're going to get those options is called the strike price. And that strike price is going to depend on the last valuation you did. If you're American or however it works in the UK, it's called a 409A or a fundraising valuation. But basically, the earlier you join, the better. Now, I'm there a second because decided whether or not I wanted to tell you something. The price at which your investors buy, right, their price per share, they are going to be for preference shares. Now, typically, although it will vary a little bit depending on the country, but say the UK and the US, it's fine. The value of the common shares or those options are not going to have the same valuation as the preference shares. They're going to have a different price, which will be based on the common shares. Typically, when you have a 409A done, you'll find that the common is valued at 20 to 30% of the preference share value. And the reason for that is that they argue that the preference shares are worth more because there's more special rights and yada yada. But basically you're doing it because you want to keep the price as low as possible when you're going to be granting those options and shares to people, okay? Because the difference between it is how they're going to make money from what you issue them or grant them at and what you're going to sell the company for on that price per share. Now, exercise. So once shares have been fully vested, it's not actually bottles and models, champagne popping time, right? The shares are only exercisable, those options are only exercisable when Huli comes to buy Snapchat or you IPO. Now the price per share of the acquisition is going to be called the exercise price. And the difference between the strike price that you got, that the staff got, and that exercise price times by the number of shares they have is going to determine how much money they make. And that's basically going to be the difference between maybe having a Lambo or having a Hyundai, right? Especially after you've paid your tax. Yay. Who doesn't love tax? But generally, the whole goal of this ESOP stuff is to start up, cash in, sell out, grow down. And it's how, it's by you giving your staff those options that they get that opportunity to sell out too. Right? Don't think your staff have done. Everyone in the office talks. They'll share their salary rates and they're probably going to talk about how much equity that they got too, right? Whilst not everyone really sort of knows what their ideal market rate of salary and equity is, they definitely understand fairness and logic. So make fairness and logical your plan for your ESOP plan. So what terms do you really need to care about. Like these ESOP docs will be fairly long and there'll be lots of boring stuff in it, but there's only a couple of things that you really need to know about. And let's go through those now. So issued shares or granted shares. Technically, granted is the word you use for options and issued is used for shares, but I think everyone knows what we're talking about here. So issued shares, how many shares in total are the staff actually potentially going to vest over time, right? Those options. The strike price, it's what do they get to buy the shares when that option is presented to them, right? That strike price is something they're going to have to pay for, okay? And it's a difference between that and the exercise price, which is their upside before tax. Now that vesting schedule, which we talked about before, that's the timeline of years over which shares are owned and can be basically exercised. That vesting can be monthly, or it can be quarterly, or it can even be daily. Now, I personally think it makes sense to have monthly and not quarterly, because the reality is if staff want to leave, what is the point of them humming around the office in sort of disgruntled, passive-aggressive mood, waiting for that quarter to come up before they hand in their notice? If they're disgruntled, they want to leave, you want them out of the office, so why do it on a quarterly basis? Monthly just makes more sense. And frankly, as opposed to daily, it just makes the calculations a little bit more simple. Now, cliff. Talk about jumping off a cliff. Right. A cliff is a trial period where no shares are vested until that cliff is met. Now, if they leave one day before, they fall off the cliff and they walk away with nothing. If they quit one day after that cliff, they get that 1 year of vesting. So it'll be, if they had a 4-year program, 25% of the total options that you had granted them. Now, there is this tricky little advanced term which we should talk about, and it's called accelerated vesting. Quite often, well, almost always, investors don't like accelerated vesting. The reason being is that you get everything that you were promised and you can just walk away. But when companies acquire you, they know that they're going to need to retain you and all your staff for that company typically to be worth anything, right? And if everyone leaves, that's not cool. So what they'll need to do is to incentivize everyone. What is the ideal thing to happen is for them to buy you and for people not to accelerate their vesting so that they are still vesting when they join the new company. And that means that you have to keep staying with that company in order to get what you were promised. Now, the reason VCs like this and don't want accelerated vesting is because they know if the investor has to put in a program to retain, incentivize everyone on the team, more than likely, they are going to decrease the valuation to compensate for that, right? The money's technically going into the pockets of the staff and not them, and they don't like that. So that's the reason why they actually don't like accelerated vesting. So accelerated vesting is basically going to answer the question, what happens for vesting if there's an acquisition? Now, there's two main types of accelerated vesting. The first one is single trigger, and the second one is double trigger. Pow, pow. If you have single vesting, you get the full vesting when there's an acquisition. VCs really don't like this, and acquirers potentially might not like it too, but as a founder, you sure as hell want it. You as a founder might be able to argue for it, but typically all your staff are going to get double trigger. Double trigger means that you have to get acquired and get fired without cause to get accelerated vesting. And double trigger is basically what everyone will get if you have an accelerated vesting clause. Now, VCs are going to demand that you create an ESOP before they invest. Okay, so don't bother trying to fight it. It's like death and taxes. ESOP happens. Here you go. Fred Wilson, really famous blogger / VC at Union Square Ventures, wrote, "I can't think of a term sheet that we have issued that didn't have specific provisions for employee equity," right? I'm just getting someone else to say what I'm saying so you believe me and don't bother fighting me on this, right? It's like NDAs, just don't ask them to sign it. Now, we talked about this very briefly. What you need to do is make a hiring plan for the next 12 to 24 months before you tell investors or get into that discussion of ESOP creation, all right? And then you're going to come up with that number is and make a case why it should be 12% and not what the VC might ask for, which is 25%. And if you've got that logic, you can have a much stronger argument with them, okay? Because it's on paper, this is our plan. What's wrong with our plan? Do you think the numbers are wrong? Well, okay, maybe we can increase them just a little bit to be what your market is. But I still see that we're more like 15%, not 25%. Why is it that you want us to have 25% instead? All right. Here is the only numbers which I can really find on the internet so far, which have come from analysis, and it comes from people who actually do cap tables. And as you can see, typically you're talking something in the region of 15-ish kind of percent, right? But the amount you're going to have over time, you see, look at the bottom, you're going to issue typically more over time. Now, the common only kind of makes sense. Series C and the Series B kind of makes sense, but a lot of the numbers don't. That's going to be kind of because of averaging. But the key takeaway is your program shouldn't really ever be more than around 15%. Okay? If it really does and there's a real reason for it, fine. But just make sure you're not giving too many options and shares away to people too early in the game. Now, we talked about the option pool shuffle. Here's a little quote on it. Don't let your investors determine the size of the option pool for you. Use your hiring plan to justify a small option pool. Increase your share price and increase your effective valuation. Because as I said, by increasing the size of your ESOP pool, you're decreasing your pre-money valuation, which is only good for the VCs. The best way to think about this is if you can increase your post-money, that's good. If you decrease your pre-money, that's bad, right? Okay, cool. What is the actual point of all these ESOPs anyway? Okay, it's to attract people and it's to keep them. So let's say you have a bunch of great data scientists, you don't want them running away to Baidu and Watson, you want them locked in and in your company, right? Well, the problem is 99% of ESOPs are actually just hit it and quit it, right? Staff are issued shares and that's sort of it. But that just doesn't make any sense. It takes at least 7 years to get an IPO. But you're incentivizing them typically for 4 years. The only company I know who actually publicly says that they've got a 7-year ESOP program for vesting is actually AngelList, which was founded by that guy who actually wrote this course, Nivi Nell, who wrote the course. Anyway, it takes 7 years to get an IPO, so your ESOP needs depth and layers, not hidden shallows like me. So most programs just basically look like this. You hire people, and that's it, right? That's just not really a great plan. All that does is attract your employees. It doesn't retain your outstanding ones and make sure that they don't leave you. So what your program should really look like this is it has 4 prongs. New hire, promotions, performance, and evergreen. And we're going to walk through each and every one of these so you really understand them, okay? These additional of the promotions, performance, and evergreen is the difference of going from good to great. And I know this makes it sound all sorts of complicated, and yes, probably the calculations to do this are going to be a pain in the butt to do, but I've done it for you. Cha-ching. Now, let's get into each and every element, and I'm going to show you then how to use the model. Okay, so let's start with the first one, which everyone knows about, and it's the initial staff issuances. So if you have the model already, great. Otherwise, just follow with me now, and you can see just generally how it works. Okay, now the first thing you want to do is to go into the staff data sheet, and you're going to add in the names of everybody. So that's going to be in this column here, which says name. And that's important because it's going to use drop-down menus so that to make sure everything is consistent and you don't mess anything up in Excel. So I've tried to make this as easy for you to do as possible and not mess it up, which, by the way, took time. Then you can chuck in their title so that you know what it is that they do, which matters when you start having lots of people. You don't know who they are anymore. Then you can chuck in their country or the department. Country doesn't really matter. Department does. And you can use the drop-down menus here and for seniority and level to put in what level you're hiring them at, okay? So that could be management, senior team. We're gonna come through what those actually are later. But anyway, and then you put in what the level is. We'll talk about those in a minute too. And then you're going to put in when you first grant them. And that's typically going to be the same day that the board approves it. This is not the date where you say, hey, John, you can have some stuff, because it's not legally enforceable, okay? So put the date they legally are granted their options. Now, if you fire them, you can put them in the termination, put the date that you fire them, the termination date, and that will stop their vesting, right? And if they have more than, if you have a cliff of 1 year and they're there for 12 months, then they'll effectively get 12 months of vested options, all right? Simples. Now, then you're gonna wanna put in what their salary is. So how much are you paying them? So check with HR, check their contract agreements, whatever. You want to put in their basic salary there, not their bonuses, because that's going to be the basis upon which you're going to issue these guys options. Now, you can put in the market salary too, if you know what it is. If you don't, you can go to this website, PayScale. It's not going to be the world's most accurate thing. This is just a website. But say you have a software architect and you're based in New York, you know that their market salary is $127,000 or $120,500. So that market salary could be $127,000, but their salary could only be $60,000. All right, maybe you got a good deal because you're going to give them options. So you can set the model to be whether or not you want the calculations to be done on their actual salary or the market salary. And that's going to be one that you're going to have to decide which makes more sense to you. Personally, market makes more sense to me. Okay, so to calculate the equity or the options, the simple thing is to create a formula that's going to apply to everybody. And then you're going to communicate that this is the company policy and it's non-negotiable. In that way, it's always fair. This is the way it's done. So if John goes into the kitchen, he's talking with Mary and she's like, how much equity do you, or how many options do you have? And he said, well, I've just got what the company plan says, just the formula. And she'll go, oh, okay, cool. And that's sort of the end of the conversation. Because if John goes, well, do you know what? I technically have 3.5% of the company, and Mary's basically doing the same sort of role as him, or, higher or lower, she goes, well, I've only got 2, and I kind of joined at the same time. That's bullshit, right? It's not fair. And that Mary may be happy with that number, but the fact that someone has got a different number to them, it's just going to ignore them. It's going to make them really unmotivated. And so just trust me when I say this, make a formula of how your structure works, and then let your staff tell everybody what they have, because that's what the program is. Of course, you may give people different salaries, but you can, again, have a structure for how you give people salaries. And a lot of big companies like Google's and IBM's, etc., have specific pay scales of how much people get depending on their seniority, which is ironically kind of how I've structured this program for you. It's fair. Okay, so the formula for calculating the base value of your shares is going to take their base salary, which is either the actual salary or the market rate. Again, we'll just take what you're actually paying them for now. You're going to multiply that by the seniority percentage, and then by the percentage you give them if they are a team manager or not. And that's going to equal the dollar value of shares that you're going to grant them. Now, we mentioned this, if you go into the assumptions sheet, you can decide whether or not you want salary or the market rate by toggling the drop-down menu. So 2 is market, toggle 1 is the salary. Easy, that's all you need to do. 1 drop-down. Senior staff are going to get more shares or options than other people, logically, right? So you need to decide on what the scale is. I've taken these numbers from a blog that Fred Wilson wrote like 10 years ago. There's just nothing else around. If you have better numbers, do let me know so I can use those to teach everyone else. These numbers kind of make sense, but I think they make sense for a later stage company. When you're earlier stage and you're not really paying people much, it makes a lot more sense to pay up more. But for the sake of consistency, you're going to have to pick on what the structure is going to be for you now. And so you're just going to type in what that percentage is. So it could be 20% for junior staff, and it could be 70% for management. There's more expensive people that you're trying to hire. So have a think, decide what it is that you want to give to people, and then set that percentage right there. And all it is just typing that percentage. Very simple. Next, I believe it makes sense to reward people who manage teams because it's not fun. So you can, if you want, decide actually we don't believe managers or team managers should get more. You can set everything to 100% and the numbers will be the same for everyone. Or you could say, if you're management and you're managing a lot of people, you're going to get 40% more. So with this calculation with the 70% and the 140%, 40% of 70 is 28. So effectively the manager, who is also a management level person, is going to be getting 98% of their salary. Does that make sense to you now? Whereas the entry person is going to get 100% times by 20%, so they're going to get 20% of their salary. That's effectively compensating people for having to manage teams. Now, with developers, that can get tricky because great developers don't necessarily need to be team managers. So that's another technicality which you might want to think about, but let's not make the world too complicated for you right now. There's a lot to learn. So how long is your vesting schedule? What is the cliff? And when are they starting? So you want to type in the cliff, and effectively you want to put that as 0 or 1. Like cliffs are very normal. I highly recommend it. So just leave what the model has already, and it's 1 year. Then you want to set what is the starting date for when your ESOP model actually starts. And that should actually be the same as when you are actually starting your program. Because in the model, we allow you to manage this for 5 years. And so every year is effectively a new year for managing that. And you can have discussions with them about giving them more incentives, which we'll be talking later on. So set that start date. That's really important. And it's not in the future, by the way, unless you're setting up your program in the future and you're just getting ready for it. It's typically going to be in the past. Now, what is the vesting? As I've been mentioning a couple of times, it's typically 4 years. That's just really the industry standard. If you want to be fancy, you could be like Angelus, you could make it 7 years, but that is not normal, okay? And you're really going to have to explain this to staff. So 4 years, just go with it unless you know something that I don't. Now, so you can see actually in the model that those numbers that you put in have been populated in the sheet. You can see that the managers are getting issued about 2.991%, whereas entry people are getting more like 0.214%. So seniority is going to matter a lot in terms of how much they're getting. Now, you can see in this example for all the staff that I imaginarily put in, that initial grant for what you did in 2016 is 11% of your total equity. You can also then see for what you've planned, how much you plan on giving to people in the future, which is effectively your hiring plan. Okay, communicating these grants to your staff. Now, you can tell people that they're either getting a percentage of the company or you're getting a dollar value of the company, right? Or dollar value based off the current valuation. Now, you might go immediately, oh, well, percentage makes sense. That's something that everyone understands and knows. Well, you'd be wrong. We are issuing you $200,000 of stock, raises a lot less questions than we are issuing you 0.0002% of the company, right? It really does make a difference. Like a dollar value is something that people can understand, whereas a tiny little percentage may sound like too little. So in negotiation, that value is grounded in itself a value that they can relate to, whereas a percentage is a proxy for value and can be irrational. And it can elicit that whole, well, my friend has 0.5% of the company, despite the fact that their company is worth 1 million, and you have 0.25% of a company that's worth 300 million. It's just very different things, whereas a dollar value makes sense. Now, a consideration that people have is people may ask, if they're more savvy, questions about how many shares are outstanding, etc. A lot of people don't give their potential or their employees any of these details. I frankly would just be open with them, especially since you have a very structured, fair, logical program. Why not? If you need to trust your staff or you don't. And frankly, secrecy can breed contempt and may undervalue the perception that people have of those options that you're giving them, which is totally not the point. Now, let's deal with promotions. So as staff get promoted, the market value of them should increase too, right? Since they can potentially get a job that makes a lot more money at another company, right? And they want to keep up with the Joneses. If you're not totally convinced, think about it this way. You're promoting them because they're awesome, they rock, and you want to keep those people and you want to motivate them. So when making hires, you can tell everyone there's a lot of potential for advancement. Well, you can also say that when they get advanced, not only will there be discussion about increasing their salary, but they'll also own more of the company to reward them for that, which is quite powerful. So what is this grant? When your staff are promoted, you're going to issue them amount of stock or options, which is necessary for you to get them to the market rate for that new position over what they were issued before. So you're just keeping it fair that and aligned with how that program is structured, which you told them, right? So how do the calculations going to work for the promotion grant in this model? Now, in the model, you just need to update the salary and the new market rate, and the calculations do it. It's really that simple. But so you know, the issuance formula is the same that we used before, but it calculates the marginal increase. So if their salary or the market rate, depending on what you're using, is 50K originally, and the new one, is 100K, they get issued according to the same formula we used before, and that salary base is for 50K more, right? It's not for 100K, it's for that extra difference. So if there's no change, there's no increase in the promotionary grant because the salary is actually still the same before. If the salary is less than before, then there's no increase in that performance grant. Now, the performance grant is allowed in the same year based on the promotionary base. If staff are paid more than the market rate already, it doesn't matter. Only the difference between the old market rate and the new market rate is paid. This may all sound like totally gobbledygook, but if you're getting really into the details, hopefully that will actually be useful for you to explain it to people. So, assumptions for this. So, to set the vesting years for the promotion grant, you want to set that again, as I reckon, with 4. So in order to retain those people. So we see the initial grant is 4, promotionary grant, highlighted in yellow, is going to be put in as 4 years. All you need to do is a drop-down menu, 1, 2, 3, 4, 5, 6, how many years you want. I again recommend 4. What you're doing is then stacking those grants so that there's never actually a good time to leave. There's an illustration later in this presentation I'm going to show you so that you can understand what I mean by that stacking. So stick with me and I'll then show you. Okay, model mechanics. If you promote someone, all you really need to do is change the promotion switch to yes. So you can see that the promotion is in the first column. It's a bit hard for me to show you. And you can see other ones for performance, etc. We're focused on promotions right now, so stick with me. You'll see that the seniority, there used to be entry, now they're director. They changed the drop-down menu. What level? They're now team manager. When are you granting them? You put in the salary, the market rate, and then you can see the calculations for the promotion grant at the box in the far right over here. So all you're going to be doing is changing the new seniority and the level. So they're team manager now. Make sure that the market value and the salaries are right. And then the numbers will basically just be calculated. So let's deal with performance now. So something startups don't have is cash. So giving bonuses in equity rather than cash has the distinct benefit of not coming out of your bank account. And it allows you to keep growing at the rate that you've been promising your investors that you're going to be growing at. So sales staff, etc., sure, they have bonuses. Why not pay them in equity too? As they create more value, they create more value for themselves. So give equity increases to only a select number of staff to make them feel special. And I'm talking only maybe the top 10, 20%, or maybe even 5%. Make it exclusive, make them want to get that performance grant. Now, the increase does need to feel large enough to feed their ego and make it worthwhile to achieve, but it can't be so large that it undermines the equitable nature of this whole program. If you're giving out too much in this, it just doesn't feel fair anymore. The recommended amount, I think, is around 50% of the salary that they would get hired for at today. So that may be too rich your blood. So just decide what you're comfortable with and pick that number. Now, what are the assumptions here you need to deal with? Again, you're going to set the vesting schedule, which is going to be 4 years again. And by stacking these again so that they're getting different ones at different periods of time, they all stack again. Again, we'll talk about that in a minute. Now, set the percentage of salary that you're going to grant your staff. I've said 50%, but it's up to you as to what makes sense. So for the model mechanics, all you're going to do is you're going to change the drop-down menu for that person for a performance grant for that year as yes. And then the model automatically, see the box on the far right, spits out and tells you the dollar value of that grant and the number of shares that they're going to be granted. Boom. Now, last one, evergreen. So large companies have long-term incentive plans, and there's no reason that you shouldn't either. If you plan on being around, which you do, you need to think about these things. So by continually issuing more shares or options, there's never a good time for people to leave. Putting in more time means that they're getting more affluent, at least on paper. Now, so this is a tool for staff to make them think long-term and make it progressively harder to leave. So this sequential stacking stuff, right? Here's that illustration that I've been promising you, and doesn't it look pretty? So we can see after 2 years, every year a small but significant issuance is added, and it has its own cliff and its own vesting schedule. And so the amount of equity that people have is going to start increasing over time. So we start with this initial grant. We've got an evergreen one here, an evergreen one here, an evergreen one here. They keep on adding up, right? That they vest over time. And if they leave, they don't get parts of it. You're going to do the same thing with your performance benefits, performance and your promotions, right? You're going to give them these new grants, which are going to keep stacking up over time. So if you only had an initial grant, this 4 years, that's when you're going to go bye-bye, right? With this, hey, they're going to double or even more than what they had originally, right? That just makes sense. So how do the calculations work for this evergreen grant? Well, the model assumes that after 2 years, you're going to start giving evergreen grants. This is, of course, up to you, as usual with this model or your own structure. Now, the comment box I've created will automatically tell you if you need to put these in to help you make sure that you don't do the model wrong. So I've tried to make it as simple as possible to help you do it. When you put in things promptly, things go blue, and then you need to add the date. You check in the model, you can see exactly how that works. Now, set the vesting schedule for that evergreen grant too, just like we did for all the other ones, 4 years again. Then you want to set the percentage of salary which you're going to grant them. This time, I reckon about 25% of their salary. But again, that is up to you. Model mechanics, all you need to do, again, change the drop-down menu to yes for that person if you're giving them an evergreen grant that year. Put in the grant date for it, and then out will spew how much that grant and the dollar value of that is going to be. So let's go through the model now so you know what's going down in Funky Town. Let's deal with the key one, which is the assumptions tab, right? General assumptions you want to be putting in here is the grant basis. So set the calculations on their actual salary or their market salary, like we talked about. Cliff, standards 1 year. The ESOP start date. So set that date when you set up your plan. Then you can see in section 4 what the current date for the formula is, and that's going to tell you how much is actually being vested. So when you look at some other pretty sheets, which we'll show you, you can actually see the calculations for what's been vested as of today. Now, if you want to look into the future, you can override that formula with the date that you want to put in. Just make sure to change it back, because that's important to show what exactly the value of the program is worth today. Okay, now next we're going to have the financing assumptions. Where you're getting into now is cap table territory. I'm not covering this in this presentation because this is going to be about ESOPs. I have videos, I have models, etc. on cap tables where you can learn about this stuff in detail. Short version is you're going to be putting in all the key details for your fundraising round to know what the exercise price is going to be for your staff. Now, I've put in 5 valuations here. Ignore the dates. I've actually changed that in the updated version of the model. What this is a series of valuations. And so every year, you may not have a fundraise. It could be a 409A valuation like we see here. Fundamentally, you're only going to fill these in when there's been a valuation change, either through a 409A or you've had a fundraising. And that's going to change the price per share and the exercise price that your staff have, okay? Simply put, you can type in what event it is, the date that it happened, pre-money, post-money, and then if you have convertible notes, then I've got mechanics to do that properly. If you have more sophisticated stuff, tough, get a cap table, and you need to then put the numbers in here properly, okay? This is not a cap table, this is an ESOP program. I just made a mini cap table for you to try and make everything easy as possible. And yes, I have a free cap table. I also have a paid one if you want to pimp it out and do a lot more stuff. So we've got a summary sheet, and that's just a summary of the output of all the schemes on a yearly basis. Yay. Now, you might notice this little thing here where there's all these little hashes. Don't freak out. It just means that your valuation has got too large. And so you need to widen out your columns to be able to see the numbers. I try to keep things relatively tight so it's a lot easier to read instead of being really wide and spaced out. So the pool sizing tab. So how big should your pool be, your ESOP pool? Well, we talked about having a hiring plan and be able to negotiate with investors on the ESOP size, right? Well, this sheet's an attempt to help you build this bottom-up calculation. And so here you can see what you should target for. So, for example, how much your investors asking for? Well, 15%. That would mean that you need to add 4.9% or 11.84% in order to be able to achieve that in your future years. And so here we can see a sensitivity table to actually see what you'll need depending on how much people are asking for. So if they're asking for, say, 15%, that would mean you need to increase it by 5%. If they're asking for 25, well, God, you have to increase that by 15%. Well, frankly, if you plan that you only need to have 5%, but you've actually planned for 10, well, that's 5% less than you needed, and that's great. This is going to help you kind of think about what people want versus what you want and what you actually need. So ESOP tab. This is all about employee details. So blue means you need to type stuff in. Yellow boxes mean they are assumptions, and those have implications. Note that everywhere I can, there are drop-down menus to keep everything as consistent as possible to minimize the potential for you fucking everything up, okay? I really did spend a lot of time trying to make this as simple as possible. I know the model is a bit complex, but I've tried to make something very powerful for you, which is actually manageable. So use the drop-down menus. Now, even if staff are hired in 3 years, their initial grant data needs to be input here. You need to input their hire year and their first grant so that the model actually works properly. If you terminate people figuratively, add in the date for those vesting calcs so that they stop vesting. So the year 0 grant, right? That's the initial one for the first issuance to the earliest of staff. So add in the salary and the market rate, simple. That's literally all you need to do here, okay? So the year 1 grant sheet, yes, things have got a little bit more complicated, but hey, you're still alive. The calcs are all done for you, so there's actually nothing that you really need to calculate. So for promotions or performance, just change it to yes in the drop-down menu if you're going to have good news for those people. Seniority, their level, is it the same before? In which case, keep it the same. If you promoted, change to their level at which they're at. For the grant date, just type the date of that actual grant, which is again typically your board date. The hire note, it just tells you kind of what you meant to do, such as add in the grant date. So salary, input the previous year data or change if they're being promoted. So if that's the same number as before, keep the same number. If they get promoted, put in what the new number is. Easy, right? So for year 2, this is basically exactly the same sheet. The only difference now is we're going to start issuing evergreen grants to your employees. Ching. So recommend that you do this for everyone, not just the elite few. Okay, you want the people that you want your company, you need to keep them there. Okay, so just switch that little drop down menu to yes, and there's nothing else to do. Easy, right? Like it's literally that easy to start issuing evergreen grants to people now. So for all the future years, you're just going to repeat what you've been doing before. You don't have to have any assumptions for future years, but they can be useful to input even if they're not 100% accurately to do planning and scenario management. So you can also use these to negotiate with staff to show them what they might get and how much cash that they might make. Now we're going to look at the vesting calcs tab now. All right, making good progress, not too much to do. I hope you haven't lost the will to live yet. I know I have. So now, don't freak out. The vesting calcs are basically a black box, which you never need to look at if you don't want to. The sheet does all the calculations to figure out the vesting situation on a per staff, per year, per structure basis. Now, the benefit of the sheet is it drives the tab staff value. You can select any staff, and this sheet spits out everything that you need to know about that individual, which is pretty freaking cool. Now, I'm not going to give you an Excel class here. If you want to understand how it works, put your nerd glasses on and get auditing. Oh, I have some here. These are my Gunnars. I do them when I'm staring at the screen a lot. They're good. I recommend them. Anyway, where are we? So the only thing I did in this model was to present all the strike prices for each grant, but those calculation assumptions are there basically to do that. All right. Now, yes, I literally have a picture of Here Be Dragons because the calculations are actually pretty complicated. You don't want to do them, but feel free if you want to get comfortable with them. So staff value tab, almost towards the end of this. This is a cool little tier sheet which you can use to show staff what their shares are worth at various points of time. Now there's only 3 numbers you can or need to change in this, and that's the staff name, the minimum value of a company that you want to present to show them of how you're showing that graph, and the increments of the value of the company, right? Now, so there's a drop-down menu with all the staff. All the names are in there, and that's why I had to put them into the staff sheet, which is really cool. Now just click the right person. We've got Megan Sampley, which is sort of a sample joke. Not really a funny one, but you know, I gotta amuse myself somehow. And everything will magically update. So you can see what shares they own, both the initial and the supplementary grants. You can set the valuation around your last fundraise or valuation or 409A if you're American. And then you see this awesome chart. And you can print this out. You can copy and paste it into a PowerPoint presentation. So the staff value line is low as Megan hasn't actually vested many shares. So that line is showing you that, right? What the actual value it is, depending on their valuation. But in 4 years, that blue line will basically be far closer to up here. But it'll never actually meet it because of that sequential stacking that you have given her. She's not going to leave because she's never really fully vested, and that messes with your mind. So it'll never actually exceed the bars, right? Or the columns. So the initial and the additional show the potential value of issuances depending on the valuation of that company at the acquisition. Whoa, almost done. Grant guidance tab. So how much should you be getting? Well, this is a hard question without much data. So if you actually have data, can you please input those numbers, send them to me, I'll aggregate them and analyze them and create a report so that I can share it with everybody. So there is no data. Help me make the data. I literally made this a sheet just to do this. It would be amazing if you do. Please do it. Thanks. That's all, folks. Next video, we're going to go through the actual Excel model, and I'll be taking you through and showing you the ins and outs and how it actually works. But that's more a high-level theoretical overview. All right, guys. Peace. Keep hustling.